Hello everyone, this is Professor Kent. This video is a review of first 5 chapters. We're going to start with the basics and then I'm going to move on to a little bit more complex, but we're going to do quite a few questions. We're going to do one question from each chapter. So the first chapter is learning about accounting equation. Accounting equation is asset equal liability plus the owner's equity. Again, it has to balance. So what we're going to do is we're going to analyze the effect of the following transaction using the basic accounting equation. So we're going to take each one and then we're going to put it into this table. So first one is we bought land. So what did we get? We got a land with the estimated fair value of 250,000 by issuing 100,000 shares. So what we did is we issued shares instead of them giving us a cash. What they did is they gave us a land. So the land will increase. If it's going to be increased, we're going to put it as a minus. Under the land we are going to have 25,000, 250,000. So that's what the value of the land will be. I'm just hoping that I could have made the I should have made the table a little bit bigger, but we'll try our best. So in this case, it is 250,000 and it is a plus. Then we have a common shares. Our common shares also increase by 250,000. If I were to think about it, this is your bridge in when you're doing an accounting equation. This is the bridge. If one account is a plus, if you use the one account which is a plus this side, the other side it will be a plus. If you have both accounts, they are under in this bridge, one will be a positive, one will be negative. Again, if both accounts in the transactions are in this side, one will be a plus and one will be a negative. Then the next one is what we did is we issued common shares for 25,000 cash. So what did we receive? We received $25,000 cash, and in this case, we issued shares, that is your 25,000. Going further, purchase 2-year insurance policies. You bought an insurance policy, it is for 2 years, then it will go under your prepaid. In this case, it's a prepaid insurance, or you could call it a prepaid expense. So we purchased it, and if you purchase it for the future, it will be a positive under the 48,000 and a negative under the cash of 48,000. So you see that 4,800. So you see in the question, if you have two accounts that are in the same line, in this bridge, and it's in the same line, one will be a positive, one will be a negative. If it's you go to the other side, one will be a positive and a negative. Let's look at this one. What we did is we bought a building. The building was worth 100,000. So that's what we did. Your building will increase by 100,000. So that will be a positive number. And this is paid 1/4 in cash. So we paid some in cash. If you purchase a building for 100,000, 1/4 of that will be paid by cash. In this case, 25,000 will be deducting a cash of 70 of the cash, and the rest balance is we have our notes payable, and they said the interest we're going to pay them is 10%. And this, if this is a note, it is a long-term debt because it's for 10 years. So we are going to, the rest will be 75,000. It will go under my long-term debt. Your entry has to balance, your transaction has to balance, your accounting equation has to balance. Purchase 9,000 of the merchandise inventory on credit. So we purchased, what did we get? We got an inventory. My inventory will increase by $9,000. Did we pay for it today? No, we're going to pay them later on. It will increase my accounts payable, and that will be your 9,000. We paid utility bill, and it is 750. Anything to do with your revenue and expenses, when you're working with the accounting equation, revenue will increase your retained earning, expenses will decrease your retained earning. So what we did is we pay 750. Then what did we pay for? Utilities. So This will be 750, and that at the side you can just call it as utilities expense, because you need it if you were to do a basic income statement. You needed to put aside what we're doing. So now let's go to the next one. What happened is that we sold $8,000 worth of inventory for cash. So your inventory, what happened to your inventory? We sold that inventory for what? We sold it for cash. So my cash will increased by 16,000. Now you are in the business of buying inventory and selling it. So when that happens, that will be your revenue. Think of it your revenue, because you're in the business of buying and selling, and you will do the physical count of your inventory at the end. So your adjust you the transaction will be, your revenue will go up and your cash will go up. Paid $2,500 for the merchandise inventory previously purchased. We're not getting a new merchandise, but we previously purchased it. Your cash will go down, and your accounts payable will go down by 2,500. We declared a dividend. At this time we just declared the dividend. Again, any revenue will increase it, utility expense will decrease it, and any dividend that are declared, if they're not paid right way, then they will be impacting your retained earnings. So in I what did we do? I have two G's. So we have in this case we have two G's. So did they tell us we had two transaction in G? I'm going to show you that second transaction too. I only did one transaction. We sold it for 16, but the cost of that inventory was 8,000. So what you're going to do is your inventory will go out by 8,000, and we have a cost of goods sold, and that will be a negative of 8,000. So this will be cost of goods sold. So in this you have two transactions. One is you're selling it for 16,000, but it costs you $8,000. So my next one was we paid, and that was 2,500 here and 2,500 here. When you declare a dividend, if we haven't paid it, it will be payable. So dividend payable will increase by $1,000, and your retained earning will decrease by 1,000. That is for, it's called a dividend declared. So we have dividend and we declare the dividend. So it will reduce your retained earning. Again, dividend declares to reduce your retained earnings. Then going to the next, this is sort of calling an adjusting entry at the end of the year. So what happens is you recognize 1 month insurance coverage has expired. Only 1 month is expired. So we bought a policy. This policy was for 2 years. So if you were to do it, how much is this policy for? It is for 2 years. In 2 years there's 12 months. So divided by 24, and then what it gives you what is the insurance per month, and that will be your insurance expense. And if it's an insurance expense, it will be minus of 2,000, and it will be called an insurance expense. And then your prepaid insurance will go down by $2,000. So now what you have to do is, these are your assets and this is your liability and equity. So what you're going to do is you're going to balance each account. So in this case, if I balance each account, the value of your cash will be 7950, and it is a positive. In accounts receivable, we don't have anything. Here we have $1,000, and it is a positive number. Here we have 4,600, and it is also a positive. Here we have 250,000, and here we have 100,000. So if you add up all these numbers, you will get a balance of 363,550. Then you do the same thing. This is a positive number and this is a negative. Difference between the both will give you a positive of 6,500, positive of 1,000, positive of 75,000, and positive of 275,000. And then what we have is you have pluses and minus. You will get a balance of 6,000 250. And if I balance that, if I add all those numbers from this to there, so you add 6,500, 1,000, 75,000, 275,000, and 650, you get a balance of 363,550. Again, this is my asset equal to liability plus your owner's equity, or owner's equity, sometimes also called the capital. Both are saying the same thing. So this is what you learned in chapter 1. What you did is you have the asset, liability, you have transactions from there, you put it in this table to make your accounting equation to balance. So we did that. So now my next question is preparing a statement of income and statement of changes in the equity and statement of a financial position. They are done in this order. So if they're done in this order, the first thing you're going to look at is statement of income. So this is what is given to you. These are the following balances. They are in my ledger account. From this ledger account, we are going to take them and then we're going to put them under the income, statement of income, statement of equity, and statement of financial position. So they have to be done in order. We always start with the name of the company. In this case, I am going to do my part A. It is Maple Grove Hardware. That's the name of the company, Maple Grove Hardware Limited. And what are we trying to do? We're going to prepare a statement of income. They have to be do it in this order in order for it to balance. And what we are doing it, when are we preparing it? We're preparing it for the year ending December 31st. So I'm going to have it for the year ended December, no short forms, 31st. And in this case, we don't know what year, so we're going to leave that blank. So when you have it, you start with my revenues. You have, first one is we have a sales revenue. So you're going to look at all your revenue, look at it, your sales, and that is my 600,000. So that is my 600,000. And when you start your first one, you always start with a dollar sign when you do that. And then if you have more than one sale revenue account, you add it. In this case, we don't have it. My next one is called cost of goods sold. So if we sold something, we're gonna have a cost of goods sold. My cost of goods sold is my 300,000, and difference between the both will give me something called a gross profit. So that will be my gross profit. Difference between those two is my 300,000. Then what we have is we have expenses, and we have a different type of expenses. We only deal with the expenses, not any prepaid expenses, just the expenses. All you're going to do is just the expenses. So we're going to go through each one, see which one is an expense. If I were to go to the first one is my advertising expense, and that I will say it at advertising, and our advertising expense was $50,000. So we already dealt with it. We have to look at each one. Then we have an interest expense. We go through each ledger account. We only picking up the revenue and expense account, and then that is my next one. It is your $10,000. We have an office salary, that's an expense. Sales salary is also an expense. Let's look at for my office salaries, and that is your $70,000. Then we have my sales salary. So we have two type of people who work in the factory, and then they both are in the admin staffs. One are office and one are sales. So that is my $100,000. So then we have supplies expense, and that is your $20,000. My insurance is 10. We may have a depreciation expense, and that is my 20,000. Now you notice that we also have interest expense, income tax expense, and interest income. We have those two, and we needed to deal with those two too. But income tax doesn't go here, it goes at the bottom. But before we do an income tax, what we needed to do is we needed to calculate my expenses. We needed to total the expenses, and these are called total operating expenses. If I add all of the operating expenses, then I will get a number. So I needed to add up all my numbers. The total that I would get is $280,000. So operating expenses are minus, and then what we get is my net operating income. So we have a net operating income. So if your revenues are higher, then we have an income. If your revenues are lower, it will have a loss. So you could have a either income or a loss. So if you have a positive number, again it will be an income. If your number comes to be a negative, it will be a loss. In this case, it will be a positive number. If it's a positive number, we call it an operating income, and then that number is $20,000. So once we do that, my next one is my other revenue and expenses. In this case, the first one, we other income we have is you could have other incomes, or you could have other expenses. So you could have a both. In this case, we have income only, we do not have losses. So they told us that we have an other income, and other income is in a form of interest income. So you have a interest income, and that number is, we only have a one, and if it's a 15,000. So if you have an income, you will be adding it. If it was an expense, you will be subtracting it. So and that gives us the income before taxes, or we call it earnings before taxes. And that is, if I add both numbers, that's 35,000. In the question, we are told that we have an income tax expense. They calculated it, and our income tax expense, that was $10,000. And then we have something called a net income. This number is very important because we take this number to do my second statement, which is your statement of equity. So net income is part of statement of equity, which is your retained earning. So let's do that. So I am going to put the name of the company. In this case, the name of the company doesn't change. It was Maple Grove Hardware Limited. And what are we preparing? We are preparing statement of changes in the equity. Then for we're doing it, in this case, when you're doing an equity, it is for that time. So in this case, we are preparing it on December 31st, and that's what you will put, December 31st. And we always start with the beginning balance. So we have something called retained earning beginning balance, or you could, if they give you a you could, either one is correct. They give it to us the beginning balance, and it is on January. You can put it the way it is. You could put it retained earnings, and it is on January 1st, and that's the balance we started off with, and that is $40,000. So what we do is, the next thing that we do is add our net income or my loss. In this case, we calculated it when we did it. My net income was 15,000. I take it to my equity and I add the 15,000 to it. Then what we have is, we have something called less or deduct. What do we deduct? My dividend. That was, if there was dividend declares are deducted. We needed to know, if I saw it when I was going through it, we have a dividend. They told us we made a dividend payment of $10,000. So if we made a payment, that is your dividend that was declared. So they declared their dividend. We only worry about the dividends that are declared, and that is my 10,000. And then we have retained earnings, and you have a balance as of December 31st, and that is, if you add them all, add and subtract, you will get a number, and that is 55,000. So again, we are going to be using this number when we calculate our next statement, which is statement of financial position. So that's the next one we're going to be doing it. I'm just going to see where I could take it. I don't have the room. So what I'm going to do is I am going to raise the side, and I will always have to. So you have the part I wanted to say is you take the net income and you do complete your statement of changes in the equity. Now we're taking the retained earning, and we're going to take that number to complete our statement of financial position. So we use statement of financial position. It used to be called a balance sheet before. So that's what it used to be called, a balance sheet. So if I were, now we're going to take the we're going to call it, it's what is that called? It is called statement of financial position. So when we say it, statement of financial position, the name of the company doesn't change. And what are we preparing? We're preparing statement of financial position. And when are we preparing it? In this case, for December 31st. So we have a December 31st, and it could be any time, any year they can tell you. Then we go look at it. What we, the first thing we start off with when you have a statement of financial position, we started off with my assets. So we have asset. Under the asset, what we have is something called a current asset. So current assets that are can be converted into cash within short term. So anything that is with the short term will be current. So you have to look at it, and you, which one is the first one that is more liquid asset. First one will be my cash. My cash balance is $5,000. So next one is my accounts receivable, and I'm doing a short form. A stands for accounts receivable, and that is your 15,000. If you're doing, if you were to do this, if you done your income statement, you could cross out what you already used, because then you don't want to use it again. So that's what the purpose of it is, to cross out every number is only going to be used once. If it's only going to be used once, then we could cross out the other things to make your life a little bit easier. So we also have, next one is my short-term investment. Normally short-term investment will come before accounts receivable. We have a short-term investment of 5,000. So we dealt with short-term, we dealt with the cash, we dealt with accounts receivable. And my next one is my prepaid insurance. So let's put my next one is my prepaid insurance, which is an asset. We paid something in advance, and that is your $2,000. So I will take $2,000. We have an inventory. I saw an inventory, which is your $20,000. So now what we did is we have to add up all of them. They will be called total current assets. So we have total current asset, we add it together, and that is my 47,000. So after the current asset, we have something called non-current, or we could say long-term assets. So in this case, that is my non-current assets. What do we have? I have a land, we have a building. So let's take it from here. We have a land is 25,000. So that's my land. And we have a building, and they told us the net amount, and it is 100,000. My building is my 100,000. So I don't see any other assets. So we are going to say total non-current assets. And then we have something called total assets. If it's a total asset, we add the current assets and the non-current asset. We add both numbers, and I will get a number of 172,000. Now we are going to go to the other side, and my others, you could put it at the bottom or you could do it at the right. So we start with the liability. Under the liability, just like an asset, we have something called current liability. So current liability, that is due within 1 year. So my current, that is due within 1 year. My long term will be that is due longer than the 1 year. So when we have it, is in this case we don't have, or we have an accounts payable and we have notes payable. Accounts payable balance is 12,000, so I will put it as an accounts payable, and that is my $12,000. And we have a notes payable that is due within 9 months, and that is due in 9 months, that's within a year. That is your $10,000. So we call it total current liabilities, and that is my 22,000. After that, we have something called non-current, or you could also call it long term. So in this case, we will call it non-current liabilities, and that we have one. And I saw mortgage payable. Mortgage is for a longer period, so I have to deal with that. We already dealt with anything. That's $80,000. So we have a mortgage payable, and that is my $80,000, and that will be your, now we have total liabilities. So what are my total liabilities? I have a current and I have a non-current, and if I add both numbers, and my total liability will 102,000. Under the shareholders equity, we have a couple things that will go here. My common shares, we are heading is shareholders equity. Under there, we first start with common shares, that is given. That's the only account we did not cross out, and our common shares are 15,000. So my common shares are 15,000, and we have something called the retained earning. Where are we going to get that retained earning? We just calculated it using the number 2, and my retained earning is your 55,000. And what we have is that if I add these two numbers, it will be called total shareholders equity. And that is my 70,000. And now I have to add these two numbers, and what am I going to get? Total liabilities and shareholders equity, and that will be 172,000. So if you look at it, they both balance. Just what we did in the first question, they all have to balance. Let's go to my next one. This relates to chapter 3. We're going to take it to 3, or a little bit 4. So in other words, we're going to do the similar type of thing that what we did in chapter 1. We're analyzing the transaction, but now what they did is they made you, what we have to do is we have to journalize them. When they say journalize it, then you have to write it, what you're debiting, what you're crediting. So when we think of a T account, we have a left side of the T account is a debit, and right side of the account is a credit. It could be any account. So when we think of asset account, we have an asset account, we have a liabilities account, and we have something called an equity account. Then we have a revenue and expense account. So asset expense works the same way, revenue liabilities and works the same way. And what do we mean by that? Wonder if the asset will increase it, it will be a debit. If asset is going down, it will be a negative number. And then what we have is, hello, hello,
Hello,
yes,
this is Sam calling from Rogers
automatically known that uh, it is if you indented it as automatically known it's a credit. So we're going to go to my next one. We paid 6 months rent in advance for $6,000. We paid cash, so your cash is going down. If your cash is going down, it will be a credit. So let's, what did we get? We got an insurance and we paid it in advance because it's 1 year's policy. uh, so we paid no, we paid the rent in advance for the $6,000 for the 6 months rent. If anything in advance, we call it a prepaid expense, or in this case, we know what we were paying. Debit will be prepaid rent, and we you could do a debit debit, or we automatically know as an accounting, if you don't indent it, it is a debit, and the amount is $6,000, and we have a cash. We indented it, and that will be $6,000. C is we paid insurance, and it's a prepaid, and we paid 8,000. When they say paid, cash is decreasing. If cash decrease, it's a credit. So I will go to C, and it is called a prepaid insurance, and we have a prepaid insurance, and it is for $8,000, and my cash will be a credit of $8,000. So we have a debit and a credit. So now we are going to go to your D. My D is saying that we bought a building. This is a similar to what we did. We bought a building, paid 1/5 of the cash, and the balance is notes payable. So that's what happened. So we bought a building, and the building we bought a building, so you will, in building is your asset account. If it's your building is your asset account, and what we needed to do is, something happened to my transactions. It should be here, I hope. Oh, it's right here. So what we did is we bought a building. So building is your asset. Your asset is going to go up, and that will be $250,000. We paid some cash. Cash will be a credit, and we indented. If we indented, we paid 1/4 of it. So we are going to take $250,000, and what we do is multiply by the 1/5. 250,000 divided times the 1/5 will give me a 50,000. Rest will be called a notes payable, and that will be for 200,000. So that they both are indented. If they indented, that means it's a credit. So then we purchase a merchandise inventory, and it is on account, and it is for $20,000. The similar type of transaction that we did in the first one. Now instead of putting it in the table, we're writing them down. So we got the inventory. Your inventory will go up, and it will be my E, and my debit will be my inventory, and credit will be my accounts by accounts payable, because we haven't paid for it. It is on credit. And how much was that? It was for $20,000. So I am going to put the 20,000. Then we're going to go to the next one. We paid utilities bill, and it's $450. If the word is paid, your cash will be decrease. If it's a decrease, it's a credit. And we paid utilities, so debit will be your utilities expense, and credit will be your cash. And how much is that? And that is your $450, and that will be my F. Then we're going to go to my G. And what is happening with my G? They said we sold $8,000 worth of merchandise for $120,000 on account. So we sold it on account. That means they haven't paid us. So debit will be my accounts receivable, and we sold it. It will be my sale, and that will be your sale will be $12,000. And then you have to do an entry for the cost. Our cost, a cost of goods sold is $8,000, because it cost us $8,000, and we sold it for $12,000. So that's how we do an entry. Let's look at my next one. Sorry. I think I'm touching something on the screen and that's why it is going away. So let's see. Oh, there it is. There. So then we have to go to my next transaction. I'm just going to write it right at the right side so that I know that I will not erase anything. So we are going to go to my next one. It says that collected 10,000 cash, a deposit from a customer for a custom order. What we collected cash. What happened to your cash account? My cash account is going up. It will be a debit of $10,000. So we received something in advance. If you received something in advance, we call it a deferred revenue or an unearned revenue. We call it deferred revenue in this book. And if you're doing another accounting course in your book, they might call it unearned revenue. That will be my credit and this will be my debit, or if I indent it, it is also known as a credit. Let's go to my next one. My next one is we paid salaries. If you pay salary and that's an expense, we paid salaries and wages expense of $8,500. So that will be your I, and we say salaries and wages expense, and that is for 8,500. And then we paid, and that will be indented. We paid cash for $8,500. So then we paid for merchandise inventory that we purchased previously. So in this case, it will be a debit, will be my accounts payable, and credit will be your cash of 8,000. So the transaction cannot be any different, doesn't matter which book you're doing it. Number K, we received something from the customers that we previously sold them. You received cash. Your cash will go up by $7,000. Your accounts receivable will go down by $7,000. So my 7,000 will go down. Then we said declared and paid 5,000 dividends. If you declare and pay at the same time, what we have is we have a debit, and that will be my dividend declared, and credit, if you paid it, it will be my cash, and it's indented. How much is it? And it is for $5,000. So again, when you put a debit, it will be on the left side, and if you put a credit, it'll be indented. So that is automatically known that it is indented. My next question is to do income statement, or we already showed you how to do an income statement. You could the question can give you a trial balance and then it'll ask you to prepare the entries. So if prepare the closing entries, or they can ask you to do an income statement and then do the closing entry. So I already showed you how to do income statement. I'm not going to show you that now. I'm only going to interested in showing you a closing entry. When we think of a closing entry, I needed to put it this way. So what we do is closing entry, we close the temporary accounts. Temporary accounts are revenue accounts, expense accounts, and a dividend declared and dividend revenue accounts. Those are the accounts that are my closing account. So when you do that, how do we close revenue and expenses? So the word here is, we call it REID. In this case, all your revenue accounts, just the revenue accounts, all close. Second one will be to close all the expense account. Third one, I stand for income summary. Income summary is a temporary account that is just there to close for the closing entry. D is your dividend. Only dividend declares are closed. So let's look at each one and see if we can close it. You could have more than one revenue accounts where you're going to look at your statement, and you're going to close everything that you have on your income statement. And that's what you, anything that sits on your income statement, you are going to be closing it. So sometimes what happens is cost of goods sold is also an expense account. So first one is my revenue account, and that is 86,400. Normal balance in my revenue account is a credit balance, and I needed to close it. If I close it, I needed to do a debit. So I will do sales revenue will be my debit, and that will be 86,400, and I will credit my income summary. Again, income summary is a temporary account, is just there for my closing entry. So that will be my first entry, is to close your revenue. Second entry, to close all your expenses. And then what are my expenses? If you look at it, these ones are my expenses. So these are my expenses. So you needed to close the expenses account. Normal balance in the expense account is a debit balance. If they have a debit balance, how would I close it? By crediting that. So first you just have to list them. That's all you have to do, is and do a total of it. And you're gonna credit first one. When you do it, you close that to the income summary account. So I'm just going to write the income summary account, and then I don't know the number yet, I have to work it out. And then what you're going to do is, you have a first one is cost of goods sold. That is your 18,200. Then we have is office salaries. Then we have rent. We have office supplies. Advertising. You have to call what is the name of the account is. In this case, it's 18,000. We have income tax. And then we have a depreciation. Anything that will sit on your income statement, everything needs to be closed other than the subheading. So I add up all your you add up all your expenses, and what you're gonna do is, you are gonna have a number, and I don't know the number. I think the number in this case, my number will be I have to get a calculator to do that. Just give me 2 minutes. So I total all of them. The total of all your expenses is 29,980. Again, you add all your expenses. So you're adding them, all the expenses. The value of your expenses is your 298,988. So do that, and then the balance is 29988. And my third entry is to close the income summary account. Again, it is a temporary account, and how do we close it? I have my first one, it was a credit, I put it on the credit side. So this is my income summary account, and we wanted to know what is the balance in that account so we can close it. Again, then the debit side I have is 29,988. And now we have you have a debit balance and a credit. So the difference between the both will be 56,412, and at the credit balance. I needed to make this balance as a credit zero balance. So in other words, what you're doing is, if the company has a net income, you will have a retained earnings. So if you close it, you will have to debit this account, and I will do a debit the income summary, and the amount of the income summary will be 56,412. and my credit will be something called a retained earning. So it will be my retained earnings, and that will be 56,412. My fourth entry was for the D, my dividend. Let's see how much was the dividend in the question, and they told us the dividend was 18,000. Dividend normal balance is a credit balance. If the normal balance is a credit balance, and then what you have to do is, in order to close it, you are gonna, for some reason, when I go back and forth, it just moves my screen. I don't like moving my screen. My fourth entry is debit will be retained earning, and credit will be my uh, dividend revenue. Sorry, dividend declared, and that was for $10,000. So I'm just gonna 18,000. So that was for 18,000. So those are the four closing entries you needed to. That's from chapter 5. You need to learn how to do the closing entries. My next question that we have to do is for the cash flow statement. Again, there's two method of cash flow. One is a direct method and the other one is a indirect method, and I'm only going to be doing a review of an indirect method. For the indirect method, I'm only going to be doing an indirect method. Then what we do is we don't worry about the interest and the cash, because that's the requirement for IFRS, that we put it under the financing activities. We're going to leave it the way it is. So of course additional information is also important, and what we're going to do is, let's put it here close to it so we could see everything. So we could see everything. So let's go to the side. What you to do in a cash flow statement: first you need a statement of income, and you need a 2 years statement of financial position. We call it a comparative. Comparative financial position. When you have a cash flow statement, you always start with the name of the company, and it is Keda Gate Industries, and it is called statement of income. Statement of a cash flow. When are we doing it? We're doing it for December 31st. So we're going to say it for year ended. So we have three activities when we are using. It doesn't matter if we're using an indirect method or a direct method. Cash flow statement has three activities. My first activity is, we call it a cash flow from operating activities. From there you could have a net income, or you could have a net loss. If you have a net income, you will start with a positive number, and if you were to have a net loss, you will start with a negative number. That's the only difference, but that's the difference between the net income and a net loss. We're starting off with a positive number, and that positive number is 165,200. And then what we do is we add all the non-cash items. So you could have a depreciation is a non-cash, amortizes is a non-cash, loss or a gain on a sale of an asset is also a non-cash. So when you have a depreciation expense, and you're going to add back, because why you're adding back, because this is an accrual. This is a cash income. This is an accrual in net income, and we needed to convert that into a cash. So we have to add back all the non-cash item. I add back the 200,000. That's my depreciation. I add my amortization, which is your 27,000, and it is my amortization expense. So then what we do is, you have a loss on a sale if it's a loss, you add it back. If it's a gain on a sale, you will be subtracting it. They told us it's a loss, and we add back the 100,000, and that's the only items that we're going to take from our income statement. That's from statement of income. And once we done everything with the uh, statement of income, then we look at our balance sheet. We're looking at your current assets and your current liabilities. So we're not going to use the cash till the later on, but we're looking at your current assets. So what are my current assets? These are my three current assets. What are my current liability? These are my current liability. But dividend arm, I'm not going to use it till we go to the financing activities. So what we're looking at is difference between the both. This is my last year balance, this is my this year's balance. Either it's increase or a decrease. So in this case, in the first number is a decrease. So we have a decrease, and it's how much is the difference between the both is my 170,000. So 170,000, you take the 350, that's the balance we had, and the balance we have now is 180. Difference between is 170. Then you look at it, is it increase or a decrease from the previous number? So this one is a decrease. So we have a decrease. So you could do all in one go, and then you could put it together later on. So we have a next one. What we have is we have receivables. So we have difference between the both accounts, and we have receivable. I think this I maybe I so we just finished the receivables, and we are going to next one we are going to go to the investment, and investment is $140,000. So that will be the difference between the both is 140,000. It went up, so that means we purchased an investment. Then we have an inventory difference between those two. It went up. If it went up, how much is it went up by? 246,000. Now because if it's an IFRS company, anything to do with investment is will also be sitting under the investing activities. We don't know if it's for short term or a long term. If it's an investment, it should be part of your investing activity. So part of your investing activity. Let's go to my liabilities. You take the difference between those two, and in this case it is an increase in accounts payable. The increases, the difference between those two is 124,000. And then what we have is we have accrued payable, and the accrued payable we have is 80, difference is 80,000, and it went down by $80,000. I don't have anything income tax there. This one there's no change. And you have an income tax, there's a change of 15,000, and it is decrease in 15,000. So whatever these numbers are, now we are going to take these numbers and we put it on our cash flow statement. So again, we're not going to touch the investments because that will be under my investing activities. The first one is my accounts receivable. You can just put it accounts receivable. If you don't want to do increase or decrease, you can put it as a down arrow key, and that is also known as a decrease in accounts receivable. If it's a decrease in accounts receivable, that means we're going to receive we received 170,000. Then we look at my inventory. What happened to your inventory? My inventory, it went up. If it went up, means that we bought an inventory, that is your 246,000. And then we are look at accounts payable. What happened to my accounts payable? It increased, means we have somebody's goods and we haven't paid for it. It is good for us because we are using somebody's goods, and that will be a positive number, and that will be 124,000. So that will be 124,000. Then we go to my income tax. We have accrued payable, and what happened? It went down. So we paid some of the accrued liabilities. So we have it went down, and it is called accrued liabilities, or accrued payable, sorry. It went down, that means we paid, and that's $80,000. So we have all the numbers that we needed. Are we missing? Yeah, one more, income tax payable, and income tax payable is decreased because it went down. If it went down, we paid for it. So income tax payable, it went down. That means we paid, how much we paid? $15,000. So that's how much we paid. Again, you're only going to use the account once, and then you are going to balance it. And once you've done the operating activities, you have to add or subtract what we have, and we could have a net inflow, or we have a outflow. So if the number is positive number, it's an inflow. If it's a negative number, we call it outflow. In this case, the number is a positive number, and I already worked it out a number. We'll say net inflow from where? From the operating activities. And that the number in there is, we have something called 445, and that is 200. And my next activity, you could do financing or investing. So let's take it to the next one. I will say it is my cash flow from investing activities. When you have an investment, you could be buying it or you could be selling it. I wanted to, if you have a purchase, when you have a purchase, the cash is going out. If you sell an investment, any type of investment, money is coming in. First we purchase an investment, so it could be a temporary or a short term. In this case, they said that we bought a trading investment. We don't know if it's a short term or a long term. And we purchase an investment, and if you purchase an investment and that is your 140,000. If you purchase it's a negative of 140,000. And then we needed to, if it's a sell, when you sell it, it could we need when you sell it, it will be a positive number. So they said that we purchase an equipment for 400,000. If they give you the word, then we just take it, and then we know what we doing. If you purchase it, it's 400,000, and it is a negative number. So let's do purchase of an equipment. And I saw we sold the land. In this case, they said land was sold for cash proceed of 220. If they give you the number, you don't need to deal with it. All you have to do is take the number and put it in. So we could say sold the land. You could say sold the land, and the money is coming in. That is your $220,000. Now we are going to go to our next one. In this case, we have a net increase or net inflow or outflow, if it's a positive number or a negative number. And I got a net outflow because the negative number is a negative. So a net outflow from investing activities. And my last activity is financing activity. Who's giving us money? When we think of who's giving us money, we think of a dividend, common shares, and your equity. So that's what we are going to do. So let's take it to the next one. And what we have is, we have my last activity. My last activity is my financing activity. Who's giving us money? And we only deal with cash items. and I have to look at my additional information. We already dealt with that. They told us number two, cash dividends was paid. If there's no change in my dividend payable, then we leave it the way whatever is declared is paid. So if you look at it, there's no change here. So whatever we declared, we paid for it. So I will say dividend paid, and that is $40,000. Then we have is we needed to know what's happening with uh, my bond payable, and what happens is there's a change here and there's a change here. There's no change here, we don't need to worry about it. So what happened is we needed to know what happens with bond payable and the notes payable. We needed to get the additional information. They said the company sold the bond for 500,000. If they sold the bond, means money is coming in. If they sold bond, money is coming in, we could put it here, sold bond, or we could just say proceed of issuing a bond. And then if the money is coming in, and that is 500,000. And then something happening with my next one is notes payable. There's a change in notes payable. If I were to look at a notes payable, this is my notes payable. I started off with 560,000. I know I end up with 180,000. If you issue a note, it goes on the credit side. If you repay your notes payable, that will be on the debit side. We don't know what's happening. They told us that 380,000 worth of principal on the note was payable, so it's saying that it went down. So 380,000, we paid it. 560 minus the 380 will give me 180,000. So we could, what we did is repayment of a note. And then we have a net inflow or outflow, and that this will be a positive number, so we call it inflow. From where? From my financing activities. I add and subtract, and what do I get? I get a number, and that's my 80,000. So I have three numbers now. I have these three numbers. I add all these three numbers, and what do I call it? Net change in cash. So we call it net change in cash. And I have a positive number. All the numbers are positive except this number is an outflow. So negative 320 and positive 80,000. If I put all together, I will get a balance of 2005 and 200. And I have a beginning balance in my cash account, and that I'm going to get it from statement of financial position, and that will be January 1st 2024. And I started off, ending of one becomes the beginning of next year. So this is my January 1st, and that will be your 200,000. And I have an ending balance that is on December 31st 2024, and that is 405 200, and that's the balance we have here. Again, your cash flow has to balance. If it doesn't balance, maybe you added something instead of subtracting it. So this was the review of the first 5 chapters. Good luck with studying. Please let me know if there's anything else you want me to record, or you wanted to see something else or another topic. Don't forget to give me the feedback underneath the video. Thank you so much for listening. Take care, and bye for now.